Thank you for attending my workshop today. My name is Kuhn, and I have been working with charities for quite a few years now. My work has been geared towards charities of all stripes, national and local, animal, welfare, religious, but the common thread is that they are charities with a noble mission, a great donor base, and desiring to be better funded in order to fulfill their missions. I started in the financial services business in 1989 after living and playing water polo in Australia. I'm a graduate of Claremont McKenna College and have been helping families with their financial affairs for 27 years. As a member of Kingdom Advisors, it is not uncommon for me to help families accommodate philanthropic wishes while protecting their financial security. My goal today is to expose you to several strategies which you can use which facilitate substantial giving without corresponding decreases in your donors' lifestyles. I call them the 12. My tagline is finding donors you never knew you had, but I thought of financial advisors can be your friends. That is mainly because I have had some development officers describe an almost adversarial relationship with their donors' advisors. And for some, it was because they couldn't stand the idea of an advisor making a generous commission for facilitating the gift. For others, it was the advisor afraid of losing revenue if he facilitated client giving. My hope is that the 12 can help mend those fences which stand between the donor fulfilling his charitable intent. I like this slide because it helps me focus on why the 12 is so handy for those of us with noble missions. Giving has been increasing, but basically it took 7 years to get back to where we were before the Great Recession. One problem for many charities has been that much of the giving has come with more stipulations. Other charities may not be seeing the increased giving because there is so much more competition for those charitable dollars. Specifically, the number of charities in the United States now exceeds 1.5 million versus approximately 1.1 million charities in 2007. Then there are the international disasters which many generous Americans have been responding to. Many gifts have been redirected from previously existing charitable relationships. In short, many charities have not seen any of those gains in giving, especially when compared to their own increased overhead during that same period of time. The other 3 points in this slide recognize the symbiotic relationship which tends to impact giving. When returns are good, we generally think giving goes up, but if it is coupled with volatile market, the donor will be more defensive and thus conserve wealth instead of giving it away. When personal wealth declines because of a business going under, a disability, the loss of a job, or any other reason, families will become financially defensive and do not give as much. In the end, given the Great Recession, many families' dollars have been pulled in so many different directions that most charities have been negatively impacted financially. They say that the definition of insanity is doing the same thing over and over again, but expecting a different outcome. We've all heard this saying, and given that you are attending my session, it does not apply to you. My hope is that it serves as a constant reminder for us to continually educate ourselves to become better stewards and fundraisers. My goal today is to introduce innovative systems which shake up philanthropy and enable you to facilitate giving in whatever economic environment and for all wealth and income levels. When I worked at AIG, the president gave me a book to read, which I found helpful for both charities and advisors. Dr. Spencer Johnson's book helped its reader to prepare for and deal with volatile times. Together, we can not only survive volatile times, but we can thrive in them. By moving your own cheese, you gain more control over the environment that you operate in. And now for the main event. At this point, what I want to do is provide a brief overview of each of the 12 and then come back to several of the more mainstream opportunities, those ideas which will have the largest target audience. What I mean by this is that each of the 12 can be useful, but not for every one of your donors. The strategies are solutions looking for a correct fact pattern. Some fact patterns will be common and some uncommon. So in the end, I will come back to focus on those strategies which will benefit a higher percentage of your donors. What you see here is several concepts most charities are unfamiliar with, and I will go into more detail for each of those in future slides. These are some of the financial transactions we will be reviewing which enable donors to use ordinary financial strategies to fulfill charitable desires. But these in particular are ways to give without a negative impact on their current lifestyle. Again, we will go into more detail in just a moment. Well, I won't be talking about these today because most of you are already familiar with these tools. I did want to recognize that these are still valuable tools in the fundraiser's arsenal. These workhorses of charitable giving go well with the 12. We are seeing a substantial rise in the number of insurance policies being introduced which provide both long-term care and life insurance benefits in one product. We call them hybrid policies. They've been developed as the answer to the question of what happens if I never need or never have a long-term care event. Early on, it occurred to me that we should be able to direct that refund of premiums or that death benefit to a charitable organization. In its simplest form, your donor can purchase one of these policies so that they receive substantial tax-free benefits to help them cover the costs of long-term care should they ever need it. Then, whatever benefit is left in the policy will be paid to their favorite charity via beneficiary designation. Because this is not a completed gift, there will be no tax deduction during the donor's lifetime. As an aside, these policies can cover one person or both a husband and wife. An alternative to this is where the donor wishes to receive a current tax deduction and you break apart the benefits and purchase two separate policies. One is a pure long-term care policy, while the other is a pure life insurance policy, which is actually gifted to the charity. Another option I'm currently researching is the use of a life insurance trust with the charity as an irrevocable beneficiary. Some advisors have established irrevocable life insurance trusts, which own these hybrid policies in order to keep the death benefits outside the taxable estate. My thought is that why can't we use this strategy with a charitable beneficiary and still potentially receive lifetime tax benefits and long-term care support via the tax-free benefits paid by the policy? Once the purview of the wealthy or large corporate buyers, fee-based life insurance is finally being offered to Main Street on a competitive basis. In the past, I had seen some policies from Emeritus and TIAA-CREF which were actually priced worse than traditionally commissioned products. The newer versions have improved client performance to a point that they are actually compelling options. If the donor has whole life, or they desire to purchase whole life, chances are this fee-based policy can save them money or grow the cash values more efficiently. The two main ways these policies can benefit charity is either by gifting the savings each year to the charity or by accessing part of the extra cash values and donating to the charity. Of course, if the charity owns the policy, the healthy donor is willing to go through new underwriting. The perks of the reduced expenses inure to the benefit of the charity. Okay, the CHIRA is not the charitable IRA rollover. It is a structured transaction which makes use of an IRA asset regardless of the donor age. The four parts of CHIRA are these. Number one is a self-directed IRA loaning money to the charity. 2, the charity purchases an annuity to guarantee the loan interest payments back to the IRA. 3, there's a life insurance policy in an amount equal to the loan principal and guarantees repayment of the loan back to the IRA. And number 4 is the remainder of the loan proceeds can be used by the charity to fulfill their charitable mission on a current basis. While the strategy was reviewed by tax authorities and passed muster, the hitch with this strategy is that most insurance companies struggle with underwriting a new policy specifically for this transaction. Thus, it is imperative that you and the donor work with an experienced life insurance professional with good insurance company relationships. Of course, it helps if your donor is one of your current generous givers. The Enhanced Diversification Account is the way I describe private placement variable annuity. Some insurance companies offer these products and allow the charity to select their own investment options. As a result, charities may diversify their investments beyond the traditional stock and bond options normally used. Specifically, there are investments charities shy away from because they are subject to taxation. If the investment committee would like to add these types of investments to their portfolio, the private placement variable annuity allows them to do so without subjecting the investment to UBTI. I have two caveats regarding the enhanced diversification account. Number one is that this should only be done with competent counsel, both tax and legal. Number two is that there is a minimum $10 million investment to add the investment managers of your choosing. The Peace Enhancement Plan is another straightforward concept. Some of your donors have set aside what I call sacred money. That is, money set aside to be used for long-term care expenses. It is not invested because the client will not take any risks with it. In short, it must be there for that rainy day. Not everyone has done this, but there are some. And some of those people with sacred money have generous hearts. These generous savers may be interested in the Peace Enhancement Plan. The Peace Enhancement Plan repositions some of that cash, some of that sacred money, into a hybrid long-term care policy which guarantees long-term care benefits and or life insurance benefits. As with most insurance policies, the buyer pays a small premium but receives substantial benefits. For instance, rather than tying up $200,000 for long-term care expenses in cash, the donor may spend $100,000 in premium for one of these policies and receive $200,000 in benefits. A portion of that $100,000 which has been freed up may be used to support your charity. The Senior Homeowners Peace Plan is similar to what we just talked about, except the donor owns a home with little or no debt. Their sacred money is tied up in their real estate. The way your donor taps into their sacred money is through the use of a reverse mortgage. This is a controversial strategy in that debt accrues against the home and must be repaid at some point in the future. In the early days of reverse mortgages, expenses were very high and consumer protections were very low. If you have not looked at this market recently, it is time to reevaluate. I don't have enough time here to discuss reverse mortgages in detail, but suffice it to say that there's a new era we find ourselves in which makes them a great option for generous givers looking to preserve their financial stability. Distributions can be taken via lump sum, monthly, or even deferred with a guaranteed growth rate of that loanable amount, or any combination of those options. For instance, a portion may be used to pay off the first mortgage, another portion may be borrowed out and sent to the charity as a tax-deductible gift, while the remainder of the loan is paid out to the borrower like an annuity. With the Senior Homeowners Peace Plan, we recommend that at least a portion of that remainder should be paid out and go into a hybrid life insurance policy. The hybrid policy will cover long-term care expenses and pay life insurance benefits at the donor's passing. These benefits may allow the donor to remain at the home and in the home longer. If the donor passes away, the death benefits can be used by the beneficiaries to repay the lender and keep the property in the family. In the insurance industry, we market a concept called annuity arbitrage. When I apply this concept to the charitable space, I term it the income gift match. Without going into all the details of why it works, I will summarize that by using both a life insurance policy and a lifetime annuity issued by an insurance company, donors can guarantee their income for life while ensuring that their heirs get the principal back at their death. And because of the law of large numbers, the insurance companies will generally only require 80 to 90% of those assets to provide the same current level of income. This leaves 10 to 20% of the investments which can be given to charity today. We call this the income gift match. In short, we're able to match current income, leave the original principals to heirs, and give 10 to 20% of the assets to charity today. Plus, for donors concerned about locking in today's interest rates for the rest of their life, There are several insurance companies which offer lifetime annuities that increase over time. Much like their Social Security payments are inflation protected, their annuity payments can also be inflation protected. Cash for life is the way I describe a life settlement transaction. I'm not typically a big fan of life settlements, but as always, I leave the decision to the client instead of making it for them. Plus, in certain situations, a life settlement is a good option. In short, a life settlement is where an institution buys your life insurance policy from you. For a donor who no longer wants his or her life insurance company, he may be able to find a buyer who will give them more than the surrender value of the policy. That is, more than the amount the insurance company would give you if you called them to cancel the policy. In general, the shorter your life expectancy, the more money you get from that institution for that policy. The two ways I see this being used for charity is where the donor still owns the policy, and number two, where the charity already owns a policy but has decided not to continue that policy. Either way, there's an underwriting process which will be used to determine life expectancy. And there is the issue of a financial institution owning the insurance policy on your life. But if these are not insurmountable issues for the donor, we're able to take that debt asset and convert it to cash, which may be used for charitable intent today instead of at their passing. Life refi is another one of those short and simple concepts. Basically, many life insurance options today are less expensive than those purchased more than, say, 5 years ago. If the donor is in good health, it is likely that their advisor can get them a newer policy for less premium. Generous clients may be interested in using those cost savings as a way to increase their giving. Of course, the other option is to use the lower pricing to buy more insurance and name the charity as beneficiary in order to create a planned gift. Either way, refinancing their life insurance can work to a charity's advantage by refinancing. I have 2 of the 12 I call the dynamic duo. The charitable gift plus annuity is one of the 2 in my duo. Almost every larger charity offers charitable gift annuities, and some smaller charities offer CGAs through their local community foundation, which has a license, at great cost, I might add. My research has also shown that the bulk of CGAs are funded by cash as opposed to appreciated assets. The charitable gift plus annuity is a transaction done by the donor using an insurance company. This means that the donor's income is guaranteed by a substantial financial institution selling thousands of annuities every year. It also means the charity is not on the hook to pay that income for the rest of the donor's life. CG plus A is sold to the donor the same way a charitable gift annuity is. This includes the payout rate. Once the donor has decided on an investment amount, we determine how much income the client will receive based on the American Council of Gift Annuities rates. Then we ask the insurance company how much premium they need in order to guarantee that level of income. Generally speaking, the insurance company should require about 75% of the investment amount. This means that on average, CG plus A frees up 25% of the donor's investment. The portion of that 25% which is gifted to charity will vary by donor. This transaction allows the charity to receive a gift today instead of waiting until an unknown point in the future for an unknown remainder interest. The charitable reimbursement plan is a way for the donor to make a donation and essentially receive reimbursement if they invest some of their fixed income portfolio in an annuity which offers a bonus. Just like banks, insurance companies make money managing assets. One of the ways they attract assets is by offering what we call bonus annuities. Bonus annuities are deferred annuities which pay a bonus on your premium in an amount ranging from 5 to 10%. The reason they can do this is because they limit your access to the money for a period of time ranging from 5 to 15 years. That does not mean that you can't access some of your money during that period of time. Most allow you to take up to 10% per year without any penalty. And All the time the money is in the annuity, the donor will earn interest, which competes very well with other fixed income investment options in the market. A simple example may help. The donor has $100,000 in a CD. When the CD matures, he takes $9,000 out and gives it to charity. The donor then places $91,000 into the bonus annuity. After the 10% bonus is paid into the annuity for the donor, he has $100,100 earning competitive rates of return, which are not taxed until he takes the money out. The life-giving team is made up of those donors who gave their insurance policies to charity. I have seen many charity websites which speak about donating life insurance policies, but in practice, most are not comfortable with the ongoing stewardship of these gifts. As a result, many charities do not specifically seek these types of gifts. Of course, even if the charities take the gifts, there's an ongoing management which must be performed, which most charities do not do, usually because of lack of expertise. One charity I worked with had numerous policies which were on autopilot and unfortunately in a state of disrepair. Some of the policies were running smoothly and were performed just like the charity thought. However, there were several which were blowing up, which is a technical term I use to describe a policy which will eventually lapse without value. This is why I hope the 12 encourages charities to look at financial advisors as partners rather than a threat. By connecting with a competent advisor, charities can rest assured that the life-giving team is at peak performance. The bulk of the recruits for your life-giving team will be those individuals who purchased life insurance a number of years ago but do not need it anymore. I can't tell you how many seniors I come across who have an old whole life policy they don't even think about. Now that the kids have grown up and moved out and they are retired, the insurance policy served its function and they really don't need it anymore. After all, it is probably a small policy by today's standards. But not for you. Even a little $25,000 whole life policy is a decent gift for any charity. Frankly, this should be an easy ask for any development officer. Traditionally, these types of gifts were viewed more as planned gifts, but there are numerous examples of how we can use these policies today for the benefit of the charity during the lifetime of the donor. However, there is another group which can also join the life-giving team, and they buy a policy specifically to give it to charity. I've also seen younger donors buy a life insurance policy to create substantial charitable legacy for very little ongoing expense. In closing, I hope you see how dynamic a relationship with a financial advisor can be for charity. Many advisors will pick up these ideas quickly because they are tools and techniques we use fairly regularly. We just need to apply them to the charitable space. Of course, I would love the opportunity to discuss any of these ideas in more detail. If you believe that these ideas would help your organization, I would welcome the opportunity to work with you in order to incorporate the 12 into your donor stewardship. Thank you again for your time.